Hello everyone, welcome to the 134th episode of me learning how to trade in Forex. So, in the last episode, we went through the last lesson of introducing the financial markets with trading commodities. We learnt about where the commodities are traded, so the different places or exchange specializing in sold a number of exchanges specializing in a particular type of commodity. So we've got an LIFFE, which specializes in like soft commodities. The New York Mercantile Exchange specializes in energies and metals. London Metal Exchange for metals that do not contain iron. ICE Futures US for soft commodities. And Chicago Board of Trades for grains. And we learned about different contract sizes. So each commodity market standard size set by the futures exchange where it trades. As commodities are often bought and sold in large amounts, the contract size also tends to be large. What drives commodity prices? Well, mainly it's the supply and demand, but also include the weather, economic and political factors, and the US dollar. And then we went through lesson summary. So after that, we are now on to the quiz for the first lesson. So, let's get started then. Welcome to the quiz. Take the quiz as many times as you like. We'll record your best effort if you log in or sign up for the IG Academy. There's no time limit, so you can spend as long as you like on each question. Cool. Spread bets and CFDs are complex instruments and come with high risk of losing money rapidly due to leverage. 71% of retail investor accounts lose money when trading spread bets and CFDs with this provider. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Okay. Question 1. For a currency pair USD-JPY, a pip represents a one-digit movement in which decimal place? Since it's got JPY, it's a second decimal place. Company QER is currently worth 5 million and 10 million shares have been issued. How much is one share worth in pence? So that should be 5 million divided by 10 million, right? So let me just get the calculator up. 5, 1, 2, 3, 1, 2, 3 divided by 10, 1, 2, 3, 1, 2, 3. 0.5 pounds, which is 50p. Index DEF is a capitalization weighted and represents the value of the following three stocks. Company D has a share price of £5 with 200 shares issued. Company E has a share price of £2 with 1,000 shares issued. Company F has a share price of £4 with 500 shares issued. What is the value of Index DEF in pounds? So just times all of them together and add them. So 5 times 200 plus 2 times 1,000 plus 4 times 500. 5,000. Which of the following isn't a commodity futures exchange? London International, that's one, LIFFE, London Metal Exchange, OMX Nordic Exchange. Match the stock index to its corresponding country. FTSE 100, that's the UK. DAX is the German one, I think. Nikkei, that's the Japan one. I think IBX is the France one. CAC is the Spain one. Match the following stock exchanges to their respective country. Nasdaq, that's America. LSE London Stock Exchange. T, that's Canada, I think. Toronto Stock Exchange. Australia Stock Exchange. Switzerland something. Which of the following be classed as hard commodities? Gold, nickel, and heating oil. You decide to buy a $10,000 of AUD USD at 0.74, which costs you 7,400. A few weeks later, the sell price stands at 0.72. If you close your position at 0.72, how much profit loss will you make in USD? Not counting any charges or commissions. Well, this is going to be a loss because the price drops. So So 0.72 minus 0.74 times by 10,000. 1, 2, 3 minus $200 loss. The size of one contract of Brent crude oil is 1,000 barrels. Let's say it's currently trading at $70 per barrel, and you decide to buy 3 contracts costing you $210,000. Later, the price of Brent crude oil is listed at $50 per barrel, and you decide to close your position. How much profit or loss have you made? It's going to be a loss again because the price went down. So that's 50 minus 70 times by 1,000. So, oh no, wait. So, 50 minus 70 times by 1,000 minus 20,000. Oh no, that's one contract times by 3, so minus 60,000, $60,000 loss. Forex is traded in standard lots. How many units of currency does a standard lot represent? It's 100,000. Okay, nice. Which one have I got wrong? So FTSE. Oh, CAC is for France and IBX is for Spain. Right. Okay. So, explanation. In most cases, when a JPY is a counter currency, the second decimal place is one to watch. Yep. So that's the value of one share is the total company value divided by the number of shares issued. So 5 million divided by 10 million, which is 50p. A capitalization weighted index takes the size of each company into account when calculating the value of the index as a whole. So, yep. Which of the following is in commodities? OMX Nordic Exchange is a stock exchange group based in Stockholm. Yep. Yep, that makes sense. Hard commodities are generally mined from the ground or taken from other natural resources, while barley is a farmed crop, so it's classified as a soft or agricultural commodity. By buying this currency pair, you expected the Australian dollar to strengthen against the US dollar. However, in this scenario, it got weaker, with you paying $7,400 to open the trade but selling for $7,200. This cost you $200. You paid $210,000 but could only sell for $150,000. This means you would have lost $60,000 in total. Fair enough, that's another way to calculate it, I guess. It's much easier as well, I think. So, yeah, standard lot's 100,000 units of currency. A mini lot represents 10,000 units, while a micro lot represents 1,000. Cool. So that's that done. Introducing the financial markets, that's done. Now we got how does I think this is the second course, right? Yes, this is second. How does trading work? In this course, we give you some key insights into the mechanisms of the trading world. We start with who's who, the people who make things happen, and how you're connected with them. Then we take a look at the market prices, showing you how they work, before finally explaining why even falling prices can create exciting trading opportunities. Yep. Let's go then. So, who's involved in trading? Who's involved in trading? Date is the 13th. Let's add a new link here. Good. So, as a trader, you come into contact with various individuals and bodies, and in some cases need their services to gain access to the markets. Here we look at these market participants, their functions and their motivations, and importantly, your relationship with them. Retail traders. The terms retail traders or retail investor generally mean a private individual who buys and sells financial instruments using a personal account. So, retail traders or retail investors generally mean a private individual who buys and sells financial instruments using a personal account, not on behalf of an organization. Not on behalf of an organization. So that will probably be you. Retail traders generally deal in relatively small sizes, often in their spare time. However, some become semi-professional and use sophisticated technology and techniques for the comfort of their own homes. As a retail trader, you have access to an incredible range of financial markets and can trade them in multiple ways to suit your preferences. Let's say you decide to buy some shares. Would you be hoping to see long-term growth, accepting that the share's value may fluctuate in the meantime, or would you be hoping for a fast profit from short-term price movements, regardless of long-term trends? If you're looking for a long-term growth, you're more of an investor, but if a fast profit is your goal, you can call yourself a trader. Investors are generally interested in overall price trends and the fundamental value of the assets they trade. Traders generally prefer to capitalize on volatility and the market reactions triggered by news events. Investors look for long-term growth, whereas traders look for short-term profits. Brokers. As a retail trader, unfortunately you can't just stroll into your local stock exchange and start dealing in shares. To buy or sell in the stock market and other financial markets, you generally need an authorized intermediary or broker to act on your behalf. You may be picturing a bowler-hatted city gentleman, but in fact it's more likely to be a company that provides an online trading platform. A broker can be either firm or individual and might offer brokers can either be a firm or individual who provides access to the who acts on your behalf in the financial markets. A broker can either be a firm or individual and might offer. Brokers could offer full service, so gone through this before, actively managing your investments and providing personal advice. Actively managing your investments and provide personal advice. Advisory management. Providing recommendations but leaving the final decisions to you. So providing recommendations but leaving the final decision to you. And then execution only dealing, which is simply carrying out instructions to trade on demand. Simply carries out your instructions to trade on demand. Of course, the greater the input you want from your broker, the higher the fee you'll need to pay. As well as representing you and executing your trades, some brokers also separately buy and sell on their own account. A broker who does this is also known as a broker-dealer. The more input from your broker, the higher the fees will be. Some brokers also separately buy and sell on their own account and are known as broker-dealer. Which type of broker do you think a brand new trader should choose? I want to say advisory management or full service, but it could be any of the above, right? I'm gonna go with advisory, because you could get some help as a new trader, but then you still want to learn the market yourself. So basically, the broker gives you hints which you could act upon, but you don't need to act upon, because then you can look at the hints and think whether, oh, should I do this or should I not do this, and gives you like your little own thinking, like tips. So that one may be advisory. Never mind. It really depends on your individual skills, knowledge and preferences. A full service broker could guide a novice trader, potentially selecting more profitable trades, but at a significant cost. The advisory management services provide some support for a lower fee. However, the client must still take the responsibility for their portfolio. So an execution-only broker might be a better value for traders willing to be able to make their own decisions. Bear in mind that there are still costs associated with execution-only trading, such as spreads, commission and financing charges. Fairs? So any of the above is fine, depending on your individual skills, knowledge and preferences. Trading on exchange versus over the counter. Suppose you want to trade shares in a FTSE 100 PLC. As the company is listed on a formal exchange, in this case the London Stock Exchange, you trade its shares on exchange through your stockbroker. An exchange has a central physical location, often in an iconic building, where brokers and dealers come together to buy and sell. Most market participants transact remotely and electronically, but some deals can be made in person by traders on the exchange's trading floor. However, if you want to trade a Forex pair, an unlisted stock, or any other instrument that's not listed on the exchange, you generally need to do so via a broker-dealer who offers it as an over-the-counter market. Over-the-counter markets has no central physical location. So an exchange has a central physical location. Over-the-counter markets don't have a central physical location. OTC markets exist as a virtual network of participants who trade with each other electronically or by phone. In over-the-counter markets, dealers set their own prices and transactions can be executed privately, with the dealing price invisible to other market participants. How are these markets traded? Government bonds, I'm pretty sure that's on exchange. Never mind, there's no central exchanges for bonds. How are these markets traded? Shares listed on New York Stock on Exchange. The pound versus the dollar, OTC. Currencies are traded between global banks and financial institutions. How these markets trade. Crude oil futures. That's an exchange, isn't it? Commodities are traded on exchanges such as the New York Mercantile Exchange. Yep. Did you know? Traditionally, trading at exchanges was conducted using the open outcry method in a part of the trading floor known as the pit. Traders shouted buy and sell orders to each other or used coded hand signals. A contract was made when one trader called out that they would sell at a particular price, and another replied that they would buy at that price. This method has largely been replaced by electronic trading systems, but is still used on a few exchanges, such as the New York Mercantile Exchange and the London Metal Exchange. Although electronic trading is faster and more efficient, some argue the open outcry system provides more opportunity for traders to get the best prices. The pit. Cool. As a summary, retail traders are private individuals who buy and sell financial instruments using a personal account. A broker is an authorized intermediary who executes trades on your behalf and may also give you advice. An exchange has no central physical location where brokers and dealers come together to buy and sell. Over-the-counter markets are traded via a virtual network of broker-dealers. Nice. So, other market participants. There are some market participants who are unlikely to deal with directly but still have a major influence on the markets and asset prices. Market makers. Suppose you want to buy a particular financial instrument but nobody is selling. Fortunately, this situation is unusual. There's generally a party who will take the other side of your trade, and it's often a market maker, otherwise known as a liquidity provider. Suppose you want to buy a particular financial instrument but nobody's selling. Fortunately, this situation is unusual. There's generally a party who will take the other side of your trades. It's often a market maker. Market makers is generally a party who will take the other side of your trade. To help keep the markets moving smoothly. A market maker is a firm or individual that holds an inventory of a particular security and quotes continuous prices to buyers and sellers. So if you place an order that goes through a market maker, it either deals from its own holdings or seek another party's order to offset yours. This happens electronically almost instantaneously. Most market makers operate within exchanges, so your broker will transact with them on your behalf. The only market makers you're likely to deal with directly are Forex trading firms, which offer clients the facility to buy or sell currencies over the counter. So, they hold an inventory of a particular security and quotes continuous prices to buyers and sellers. So if you place an order that goes through the market maker, it either deals from its own holding or seeks another party's order to offset yours. This happens electronically almost instantaneously. Most market makers operate within exchanges, so your broker will transact with them on your behalf. The only market maker you likely deal with directly are Forex trading firms, which offer clients the facility to buy or sell currencies over the counter. Yep. Institutional traders. Institutional investors or traders are organizations that deal in the financial markets, generally on a much larger scale than retail traders. As a retail trader, you may have little contact with these institutions, but it's useful to be aware of their activities. Institutional traders manage pools of money on behalf of individual investors. Institutional traders manage pools of money on behalf of individual investors, and this means they sometimes make trades of a magnitude such that they influence market price movements, particularly in shares. Institutional traders include banks, life assurance companies, pension funds, mutual funds, hedge funds. Institutional investors or traders are organizations that deal in the financial market on a much larger scale than retail traders. They manage pools of money on behalf of individual investors. Such that influence market price moves. As a result, they can make trades with a magnitude that can affect the market price movements. Institutional traders include banks, life assurance companies, pension funds, mutual funds, hedge funds. The large size of these institutional traders' positions means that they can sometimes receive benefits such as reduced commission rates. Fares. Did you know, typical institutions have a high level of trading expertise, but just occasionally this isn't the case. In the 1990s, UK institutional investor Barings Bank employed the now infamous Nick Leeson as one of its traders in Singapore. Leeson amassed losses totaling 827 million through unauthorized speculation on the Japanese markets. He successfully concealed his fraud until the Kobe earthquake caused Asian markets to crash, and with them Leeson's trades. When his losses were revealed, they resulted in the bank's collapse. Oof. High frequency trading. The development of ever more sophisticated technology has given birth to a specialized kind of institutional trading, high frequency trading. High frequency trading uses computers to automatically apply trading strategies and algorithms, finding and exploiting patterns, trends and tiny fluctuations in the market. Instead of employing teams of analysts and traders, an HFT firm relies on a technology that can make multiple trading decisions in a fraction of the time it takes a human brain. This means high-frequency trading firms can open and close positions in a space of seconds, milliseconds, or even microseconds. They can make these ultra-short-term trades in immense volumes, often aiming to capture just a tiny profit on each one. High-frequency trading traders are the polar opposites of the traditional long-term investor, as they never accumulate portfolios or hold positions overnight. Their bread and butter is momentary market changes rather than steady growth. High-frequency trading firms are so far removed from the world of retail traders that their activities have little significance for you. High-frequency trading is occasionally thought to contribute to general market volatility, and high-frequency trading firms can also benefit the market by acting as liquidity providers, but neither of these things will affect your trading decisions. So, uses computers to automatically apply trading strategies and algorithms finding and exploiting patterns, trends and tiny fluctuations in the market. They aim for ultra short term trades in immense volumes. HFT firms are so far removed from the world of retail traders that their activities have little significance for you. HFT is occasionally thought to contribute to general market volatility, and HFT firms can also benefit the market by acting as liquidity providers, but neither of these things will affect your trading decisions. Okay. Lesson summary. A market maker provides liquidity by holding an inventory of a particular security and quoting continuous prices to buyers and sellers. Institutional traders manage large pools of money and trade the financial markets on behalf of individual investors. High-frequency trading uses technology to apply algorithms, placing vast volumes of ultra-short-term trades and capitalizing on brief market fluctuations. Cool. Buying and selling. As the saying goes, it takes two sides to make a market. The two sides concerned are buyers, who usually believe that an asset's value is likely to rise, known as bulls; sellers, who generally think an asset value is set to fall, known as bears. Two sides of the market. Bulls, bears. Bulls, buyers who think who usually believe an asset's value is likely to rise. Bears are sellers who usually believe an asset's value is likely to fall. Buyers, sellers. I have to say, the relationship between them powers the movements in the market prices. Let's look at how that works. Suppose you are buying a car. You look for the lowest price in the model you wanted, and if other buyers were thin on the ground, you might strike a good deal. On the other hand, if you were trying to bag a rare and a sought after vehicle, you might have to pay the seller a high price. In the same way, the balance of demand from buyers and supply from sellers influences price in the financial markets. Supply and demand. So, supply and demand powers the movement in the markets. So, as the demand is increasing, but the supply is decreasing, or kept the same, then the price rises. As the supply and demand are pretty much in equilibrium, so two sides are pretty much about even, then the price is stable. But as there's more supply than there is for demand, then the price falls. Cool. How levels of supply and demand move prices? Which way would you expect levels of supply and demand to push prices in these scenarios? A company releases poor annual results. I know share price falls, but the reason for that is because, so if the annual results falls, then I guess the value of the company falls, right? So the value of the company falls. Oh no. So if poor annual results, right? If the poor annual results come out, that means the company isn't doing as well as it should be. So if it isn't doing as well as it should be, then the investors, I'll be like, should I really invest in this company, put my money into this company if it's not doing as well as I think it would? So then they would begin to pull out. Some of them would be like doubtful and begin to pull out. So then the company, the amount of shares available is still the same, but as more people pull out, that means the demand for the shares decreases. So if the demand decreases but the supply is still the same, then the price falls. Disappointing figures will probably make the share unattractive to investors. The resulting sell-off will increase the supply, causing the price to slump. Yeah. Which way would you expect level supply and push price in this scenario? Political instability in an oil-producing region threatens supply. So, if the supply is threatened, that means it could be possible that the supply for the oil is going to be decreased because they're not sure that they could actually get the supply that they think they're going to get. So, if the supply decreases, but the demand is kept the same, then the price is going to increase. Fears of shortage of oil to meet the world demand are likely to drive up the commodities price. Which way would you expect supply and demand? The Japanese government announces policies designed to depreciate the yen. Depreciate the yen. So depreciating the yen means it's not going to be worth as much. So if the value of yen isn't going to be worth as much, that would mean that the currency is weakening against USD. So if JPY is weakening against USD, that would mean you would need more JPY to buy 1 unit of USD. So USD JPY price rises. The yen will turn to become less attractive to investors, increasing the relative demand for the dollar and lifting the price of USD JPY pair. Yep, okay. Bid and ask prices. When you look at a quote for a financial asset, you generally see not one but two prices. When looking at a price, at a quote for a financial asset, you'll see two prices. Bid price, the price you'll receive as a seller, ask price, the price you'll pay as a buyer. The ask price is also known as the offer price. In a quote, the lower figure which is shown the lower figure shown is normally the bid price and the higher is the ask price. In the quote, the lower figure shown is normally the bid price and the higher figure shown is the ask price. So let's say you feel the euro is set to strengthen against the dollar, so you decide to buy euro USD. Your broker quotes the bid price of 1.23546 and an ask price of 1.23554. Which price will I apply for your trades? So you want to buy. If you want to buy, then you look for, it's the 5541 because there's buy here. You buy at the ask price of 1.23554. Put another way, you pay $1.23554 for each euro you buy. Meanwhile, sellers receive 1.23546 in return for each euro they trade or they sell. Yeah, so you'll always be selling lower than you're buying. Otherwise, if it's the other way around, you're going to have infinite money glitch. So, can't do that. Yeah, okay. The spread. So why do different prices apply for buyers and sellers? The gap between the bid and ask prices occurs because buyers and sellers often have contrasting views about the value of an asset. The bid price is the highest price at which a buyer is prepared to buy. The ask price is the lowest price for which a seller is willing to sell. The gap between the bid and ask price occurs because buyers and sellers often have contrasting views about the value of an asset. So the bid price is the highest price at which a buyer is prepared to buy. The ask price is the lowest price at which a seller is willing to sell. So the bid price is the highest price at which a buyer is willing to buy. The ask price is the lowest price at which a seller is willing to sell. The difference between the two prices is known as a spread. The difference between the two between bid and ask price is called the spread, and also as the bid-ask spread or bid-offer spread. The spread may also incorporate a broker's fee for handling the trades. The broker quotes clients a price slightly lower than the fundamental bid price or slightly higher than the ask price, keeping the difference to cover its costs. Broker quotes you slightly higher than the ask price, so you're paying, say, 1.31 for what the broker's offering you, but then the actual price is 1.3. So you pay 1.31 to the broker, and then the broker buys it off from the, I don't know, liquidity provider or whatever, I think, for 1.3, and then the broker keeps a profit of 0.1 or 0.01 pips, 0.01 pip, right, like that. So let's do a summary. The balance between supply sellers and demand buyers drives price movements in the financial markets. Supply sellers, demand buyers. The bid price is the price you receive as a seller, while the ask price or offer price is the price you pay as a buyer. The gap between the bid and ask prices is called a spread and occurs because buyers and sellers often have differing views about the value of an asset. Supply is the sellers and demand is the buyers. Cool. So I'm going to leave this episode here. In the next video, we're going to carry on with how does trading work with what spreads mean for traders. So thank you all for watching. Bye bye.